Having the right attorney is a key component when buying or selling a business. I have seen firsthand the value that a seasoned mergers and acquisitions attorney can add for their clients. Let me tell you about a law firm that I have worked with and would highly recommend for anyone thinking about buying or selling a business. Benjamin Gussin and Associates. They are a law firm that has been representing buyers and sellers of businesses for more than 30 years. Believe me, they are experts. Not just experts in business transactions, but also real estate and tax guidance, which are both often required when buying or selling a business. From the initial steps reviewing a letter of intent, right through to closing, the attorneys at Benjamin Gussin provide the personalized service and experience needed for putting the pieces together for a successful and flawless transaction. I've known the lead M&A partner, Lee Gussin, for many years, and I have never hesitated referring a client to him. So if you're looking to buy or sell a business, feel free to reach out to Lee at 847-861-6220. That's 847-861-6220. I thank them for sponsoring today's episode and hope you enjoy it.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
M&A Unplugged community, if you want to understand how businesses are valued, then you are in luck. Joining me today is one of the principals of GCF Valuations, Darren Mize. Darren is someone I've known for almost 15 years, and I can only imagine the thousands of companies he has valued across all industries in that time frame. GCF Valuation is one of the premier valuation companies in the U.S., so much so that they have had a hand in writing the standard operating procedures which lenders must follow when using a business valuation for an SBA 7A business acquisition loan. GCF is known in the valuation industry for their deep expertise and exceptional deliverables. GCF has multiple offices across the country with a 14-person staff that includes 5 accredited business appraisers. We've involved Darren and his group in a number of situations throughout the years, and they have always delivered outstanding results. Darren, welcome to the M&A Unplugged podcast. So I'm so curious, do you have any idea how many valuations you've done through the years?
Well, first of all, thanks for having me, Dominic. Pleasure to be with you today. I would say that I couldn't give you an actual number, but I would tell you that we've probably averaged anywhere from 1,500 to 2,500 valuations a year. So there's a good amount going on there, that's for sure.
Yeah, it was a little tongue-in-cheek, but I know you guys just do a lot of volume. You've seen a lot of situations. But before we dive into all of that, can you give everybody a little bit of background on a little more on GCF and how you guys started this and where you're at today?
Yeah, sure. Real quick, I think all this started about 24 years ago. My younger brother and I were looking for something to do, and he happened to pick up a job with a brokerage firm in Tampa, Florida, and they hired him to help them appraise the businesses that they were trying to list. And it became pretty evident that this was a need or a demand in that particular industry. And as we did our research, especially around the state of Florida, there were plenty of business brokerage offices around that state and around the Southeast that were in need of these kinds of services. That's really kind of how we got into the business. We started GCF back then to serve just business brokers. And it evolved into something much larger than we had ever expected, starting with a conference that we did in Clearwater, Florida, next to, at the time, one of the first SBA lending groups out there to start doing SBA loans. And they asked us if we could do a business evaluation for one of their loans. We said, sure. And as it turns out, that's kind of what put us on the map. So it's been a good ride for the last 23 or 24 years. And, the volume continues to increase. We're very excited about what we've been able to put together over the years and certainly have a great staff to help us with that.
Yeah, just being in the community, I can say you guys really have set yourselves apart. You're the gold standard when it comes to valuations. And I know the folks that need this sort of work point to you time and time again. And you sort of hinted at it. You've gone way beyond doing valuations for just brokers and M&A intermediaries. You're also doing them for banks. And I know I'm going to interview your brother in a couple of weeks, and we're going to talk about the bank process, but you're coming at it from both sides. You're doing it for sellers and buyers, and then the banks are calling on you to validate valuation as well.
They are. And, not surprisingly, you'll find that we see a lot of the clients that we work with on the front end of that process, also on the back end of the process as well. So we see a lot of those individual buyers that are acquiring these businesses going through the SBA lending process. And we end up seeing them with our SBA lending clients as well. So it's an interesting process to see from start to finish. And luckily for us, that's given us an incredible amount of experience to really follow it through with the clients that we work with.
Yeah, that's got to be so interesting. If you get involved, if a broker brings you in and gets you involved in doing a valuation upfront on a business, then to maybe many months or a year or two later, see that same business come back around and the bank now ordering a valuation. Hopefully there's few surprises, but knowing what I know about this industry, there probably are.
Well, we know what to expect. So luckily, and again, going back to the experience of really being a part of the process, both in the beginning of it and at the end of it, when the transaction actually closes and gets a loan, the experience and understanding how that process works provides us with the ability to help coach along the way and to try to help set expectations as to what to look for, both from a seller's perspective, a buyer's perspective, and even a bank's perspective. So we do see some surprises from time to time, but they're not as much now as they used to be a long time ago.
Yeah. So like I referenced, we're going to talk to your brother in a couple of weeks about the banking side. So why don't you and I spend some time talking about valuations from a business owner perspective and from a buyer perspective? And why don't we tackle those one at a time? So why don't we start on the owner side? In your experience, when it comes to valuations, what are the top things that business owners should be thinking about to maximize the value of their business so that when you get it and you look at the file, you're giving them, the top multiple, they're getting the highest valuation?
Well, it's some things are in their control and some things are not. So obviously you want to focus on the things that are in your control. So if you go back to the premise of really what drives value, and really when it comes down to it, there are lots of things that have an impact on the value of a company. But the two key components that we like to try to focus on with our clients is cash flow and risk. So starting with the things that you have control over, those are the two ingredients to the puzzle there that will really get you from point A to point B if you want to try to provide yourself with the ability to help get you to a number that you're looking for. Cash flow being really the financial strength of the company. And, if you want to get into adjustments to income statements, we can do that. But ultimately, the value of a business is being driven from the company's financial performance and then also the risk that the company has within its particular industry and just in general. So when you look at it from that perspective, it's a simplified equation. You want to maximize your cash flow and you want to reduce the risk as much as you can. And when you can put those two together in that format, you have the ability to truly maximize the value of the company.
Well, I think those are two great foundational points to dive into. So why don't we unpack those a little bit? Why don't we talk a little bit about cash flow and then we can go over and talk about risk. So when you talk about cash flow, what are the key components that owners should be thinking about so that they're maximizing that or putting that piece of their business in the best light?
Well, the one thing that we all clearly understand when it comes to privately held businesses is that each business owner is doing the best that he or she can do to minimize tax burden. So when you file a tax return, you may have some expenses inside that tax return that could very well be either non-operating or something related directly to the owner. So the first thing that you want to be able to do, and I would suggest that if you're going to do this right, you need about 3 years to do it. You really want to clean up your income statement so that when you look at a 1-year profit and loss statement or a 1-year tax return, you have as little in the way of financial adjustments as possible. That's the first thing that you need to do. And sometimes that takes a while because there's a lot of commingling of personal and business expenses inside of that financial statement that you want to try to clean up. And that's that's the first thing that you really need to focus on, is getting that financial statement clean, because ultimately what you're doing is, one, you're eliminating the information and support that you're going to have to provide somebody that's going to look at that financial statement. And two, you're essentially reducing your financial risk at the same time. So that would be the first common denominator that I would focus on when it comes to value and financial statements.
And Darren, the natural pushback there is, when you clean that stuff up, the tax burden on a yearly basis goes up for the owner, right? I mean, they're going to be showing potentially much more income. They're going to be paying higher taxes. But the net effect, if I could distill what you're saying here, is that they're going to be paid much more for their business if they clean those aspects up.
Sure. And I guess if you want to put it into a very simplistic understanding of it, you can either have those expenses inside your financial statements, reduce your tax burden and not pay as much tax and gain your value that way, or you can clean up your financial statements, remove all of that excess, pay your tax and pay it over the course of the next 2 to 3 years, and ultimately gain more value in the sale of your company. So it really comes down to a personal choice. I think at the end, a lot of people try to do both, and you can't do both. So you have to be clear as to what your objective is. And that's why, I always suggest, 2 or 3 years in advance, you got to figure out how you want to tackle this. Because if you're looking to maximize the value of your business, the only way that you're going to have to do that is you're going to have to pay some tax. And that's just the nature of what you're dealing with.
Right. No, what you're going to pay it up front, or you're going to pay it later on.
Exactly.
And the argument for later on is you're getting many multiples of those dollars that you show in profit, adjusted EBITDA, versus, not getting those multiples if you're taking the benefit of not paying the taxes as you go along.
Exactly. You're increasing your cash flow. You're increasing your profitability and your profit margin. Those are all what we'll call negative risk factors, meaning that you're reducing the risk of the financial side of the equation. And when you reduce that risk, your multiples are going to increase as a result of that.
So these financial adjustments, they're not all created equal, right? Some are easy to show, and many of the banks will accept some of them, right? And then some get a lot murkier. Any guidance there as far as, financial adjustments that increase your expenses, things maybe you should steer away from?
I don't know that there's things that you can steer away from. I mean, as a business owner, you have the capability of paying for personal items through your company credit card, your company checkbook. When it comes to, in a perfect world, you want to stay away from all of that. You would want to run the business like a publicly traded company. You want to have strong profitability every single year. You want to pay your tax and be clean. And, going back to what we were talking about earlier, the cleaner the books, the more value you're going to see in the company. When it comes to those cash flow adjustments, they're all pretty common. I mean, if you look at the garden variety business owner in the private sector, you're looking at things like automobile, travel, entertainment. You've got some family members that you may be paying a salary to that either work there or don't work at all. You may be paying for certain home-related expenses through the company, especially if you have another home office that you run office supplies through. So, as long as we've been doing this, I don't see anything out there that's too uncommon. The one thing that we always try to stress, however, is that when it comes to the item that you're trying to add back, meaning that the expense that you're trying to remove, you have to be able to see it before you can remove it. So if it's there, you can take it out. If it's not there, you can't. And some people fail to recognize that.
Yeah, so important. And, so maybe we could talk a little bit about the balance sheet as well, because we do spend an awful lot of time on the income statements. And what I have found over the years is not enough people spend the time and effort on their balance sheet to make sure that, it's really clean and really depicts how the business operates.
Well, the balance sheet can be another form of financial strength for the company. Now, obviously, depending upon the kind of business that you're in, your balance sheet may be small. It could be big. But if you look at service-based businesses, you look at CPAs and insurance agencies and those kinds of service-related companies, you're not going to see much on there. Maybe some desks and some chairs. Whereas when you're dealing with transport businesses and companies that deal in heavy machinery and equipment, whether you build it, sell it, you might find that the balance sheet is much larger as a result of those items. The one thing that you always will see, however, is you're going to have assets and you're going to have liabilities, and ultimately it's the same thing as an income statement. You want to remove anything that's non-related to the company. It could be personal loans, whether you're receiving them as an owner or you're giving them to the company as an owner. and anything, any investments that aren't related to the company, life insurance policies that aren't related to the company you want to remove. So you can take the same exercise here just by removing those items to make your balance sheet, again, as clean as you can possibly get it.
Yeah, and there's so many other things to talk about in the balance sheet, but we can go on and on. I had an accountant on, a principal from a firm here in Chicago not too long ago, and he gave me a statistic that blew me away. He said that in 90% of the deals that they're involved in, the inventory becomes an issue as it relates to the net working capital, that, somehow, inventory wasn't measured the right way. They weren't doing physicals, and it really threw their balance sheet completely out of whack, which then has an impact on the income statement potentially, right? And so, it's all of those things, making sure that you have a well-groomed balance sheet that really accurately reflects the business.
Well, and you're absolutely correct. And I think when it comes to small businesses, as you can probably imagine, that most small business owners don't have time to put in the certain kinds of management protocols for the balance sheet, especially when you're dealing with lots of machinery and inventory, particularly. The good news about having a business valued in advance of going to market or just trying to determine what you're looking for in terms of value, an appraiser can pick up on things like that. So when you're looking at a business that's not performing as strong as it should be based on its cash flow and its profitability, sometimes you can look to the balance sheet to find out why. And many reasons you'll find that they're not adequately using their equipment or their inventory properly. And you also might find that some of that stuff they probably aren't even using at all. And at that point, then you got to remove it. And that does help out a little bit.
Yeah, I know that in the evaluations that we've done with you, that's a common question that you ask us is, what about the equipment? Is it all in use? Is there excess equipment? Do they have enough to facilitate the ongoing sales of the business at the current run rate? Those are all important aspects.
Well, it all comes down to developing a company that is efficient as possible. And, a lot of people make the assumption that having lots of machinery and equipment and lots of tangible assets makes the company better and makes it bigger, when in fact it doesn't. You're ultimately looking for a business that generates as much cash flow as possible with as little as possible. So when you're looking at the asset column of the balance sheet, you don't have to have a lot of assets to be a strong company. So always keep that in mind, that it's doing as much as you can with as little as it can to be as efficient. And when you are efficient, value comes from that as well.
Absolutely. So Darren, are there other things that we should talk about in relation to cash flow, or should we move over to risk?
Let's talk about risk for a little bit.
Okay, great.
So risk is obviously a perception. There are certain aspects of risk that you can see, that you can identify, that anybody would agree with. And then there are certain things that may or may not be in agreement with, between, if you show something to 5 different people, they may have 5 different opinions on it. So risk is really the loose gun here on the equation when it comes to value. So you go back to the idea that you've got cash flow and you've got risk. Risk ultimately is what's going to drive the value up or down. And that's really where you start, is looking for risk. And risk comes in a lot of different forms. So from an appraisal standpoint, you've probably got 8 or 10 different categories that we would look at to determine how risky a company is or how strong they are.
And could you give us a couple of those just so we have a sense for what you're looking at? I know you have a whole questionnaire that you have people fill out that cover a lot of these points so that you can really drill down if you have to as you're going through the valuation, but maybe we can unpack a few of these.
Sure. I'll touch on the common ones. So when we're looking at a company as a whole, our full objective is to develop our risk analysis on that individual company. And what we're doing by taking that approach is we are trying to identify how strong or how weak the company is based on just its operation and how it performs. And so risk becomes a key component of that. So when we're looking at the different risk factors, we look at probably the following 4, 5, 6 different categories. So we look at the company's dependence on the owner. So dependence on the owner is typically pretty common in a small privately held company. The less dependence on an owner there is, the less risk there is. So you want to make sure that you try to identify that. We also look at financial risk, as we talked about earlier. We look at financial trends, how the business is performing over the period of the last 3 to 5 years. Are they moving up? Are they moving down? In addition to that trend, you want to look at how strong their margins are. So if they're generating a lot of cash flow, but their margins are below average, that's a risk that you have to consider. A big risk factor that can't be ignored is customer concentration or supplier concentration. A lot of people fail to recognize that the single largest value killer when it comes to valuing a privately held company is concentration of one or more customers. So that's something that we look at. And then you got other things, industry risk, economic risk are some of the other things we look at. And there's probably 3 or 4 more, but those are the most common ones that most people can relate to.
So when you deliver a questionnaire to the owner of the business, they fill it out, and how do you drill down on some of these items as a valuation company so you get comfort one way or another? So when you get to the bottom line valuation, you feel good that you've taken everything into account.
Well, it's a double-edged sword because, when people engage us to value their business or working with consultants or other people that are working with the business owners themselves, they tend to be in a hurry. Everybody wants to get things done quickly. And while we can certainly understand that, we always try to tell our clients that we don't want to sacrifice quality and accuracy for time. Because ultimately, if you end up rushing, you're going to miss some things. So, our job, unfortunately, for most people who don't we ask a lot of questions. And we will ask as many questions as we can ask until we are satisfied with the answer that we're trying to obtain. Just looking at a set of financial statements and asking, I see that you've increased your revenue over the last 3 or 4 years. How come? And they may give you an answer, we've just added a couple more products. Well, that doesn't satisfy our curiosity. We want to know more. We want to be able to explain it because in the valuation report itself, you have to treat it as if somebody who's reading it doesn't know anything about this company at all. So detail is really what it comes down to. And ultimately, we won't release the report at all until we're comfortable with where we're at.
Got it. Yeah, makes perfect sense. Darren, we're launching a new business here probably in the next 30 days. It's going to be all focused on helping business owners and business buyers prepare for their transactions. And, the mantra is, do it early, do it often, get ahead of the curve. It increases your options. And so from your perspective as a valuation company, how often do you think an owner of a business should be, getting a snapshot value of their business, at least, and then how often maybe doing a deep dive?
Well, I think it depends upon what the ultimate objective of the business owner is. There are lots of different valuations for lots of different purposes. So one purpose may be estate planning. Another purpose may be key man life insurance. Another purpose may be an employee stock ownership plan. Another purpose could be taking the business to market. So I think it really does depend upon what the overall objective is for the business owner to determine what to do and how often to do it. I would say just as a form of internal management that you would like to have the value of your business at least once every couple of years, just so that you have a basis and a benchmark to understand what you want to try to accomplish looking forward. The only downside to that is if you don't have the valuation done on an annual basis, it can be a little bit more costly down the road. So if you can afford to do it once a year, it's going to save you a good amount of money in the long run. But at least once every 2 to 3 years is probably a good benchmark for that.
Yeah, that's the mantra that we've been following is, every couple of years, at least get a snapshot, understand where the business is. Have you moved the needle, especially with some of these risk factors, right? Because some of these risk factors are within your control. You can move the needle on some of these and improve value along the way. And a great way to test, how the value has been impacted if you've been able to improve some of these risk factors.
Well, think about the fact that many business owners focus on one thing. It's their top line. They don't really focus on the bottom line a lot. And so you may find as a business owner that you are doing very well. You've just had your business valued. You're moving along at an 8 to 10% revenue increase every single year. You believe as a result of that the value of your business is growing at the same time. But you might find that by having a business valuation done once or twice throughout that period, that instead of growing with revenue, your profits are going down because your costs are going up. And you may not necessarily see that. And so the ability to be able to determine all aspects of financial strength definitely ties into value. And if you're monitoring that on a regular basis through a business valuation, you have a better sense of management looking forward. And I think that's important for any business owner.
Yeah, that's in the category of you have to really know what's happening, right? At all times. Not all growth is good growth, right?
Right. And sometimes we'll tell people, I'd rather see your revenue decline and your profits and cash flow go up. Because ultimately what you're doing is you're streamlining the company. You may be getting rid of some unprofitable customers that may be driving a lot of revenue for you, but may not be very profitable. So you want to, in order to maximize your business, you want to make sure that you pay attention to your top line. at the end of the day, if cash flow and risk are driving the value of your business, the bottom line really should be your main focus.
Yeah, without a doubt. Without a doubt. So why don't we move over to the buyer side of the equation and talk a little bit about what buyers should understand about valuations and approaching a business?
Well, I would say that, we've been doing this for a long time, as you mentioned. Well, the one common thing that I have seen over the years that has not changed when it comes to buyers, and really when it comes to sellers too. I mean, you could probably put this on both sides of the equation, but from a buyer's perspective, there is an emotional attachment to buying a business. Or really, there's an emotional attachment to buying anything if you think about it, but especially when it comes to business. The idea of leaving your job and buying your own job and working for yourself and having the ability to run your own company and to manage your own time and schedule is very appealing to anybody, especially if you're going to get paid for it. But the one thing that you can't do when you're looking at acquiring a business is overpay for it. And a lot of people are willing to overpay for it because it's an emotional discussion. It's an emotional decision. When you're looking to acquire a business, you have to take the emotion out of it. Otherwise, you could find yourself in a position where you're overpaying for a business, and that's not good for anybody other than the seller. So that's the first thing that I would tell people when they go into this process is you have to have a set of parameters as to what you're looking for. And if you are looking at something that falls outside of that parameter, you need to walk away or try to negotiate. That's the best thing I could do.
Yeah, so true. Your biggest strength in any negotiation is your willingness and ability to walk away. You get tied up into it emotionally, and you could start to make some really bad decisions.
Absolutely. And you don't want to do that because really, when you think about the idea of acquiring what likely will be your most valuable asset and your personal worth, you don't want to make bad decisions when it comes to acquiring a business.
Yeah, absolutely. So what assumptions do you make from the buyer's perspective when they're looking at the value of a business? Do you look at it slightly differently when a buyer comes to you and says, look, I need to value this business than what a seller might have done?
The process in valuing the business itself is really, that doesn't change. When we work with buyers, obviously what we're trying to do is set an expectation of what we believe would be a fair price for the business. And then ultimately, if you're willing to pay a little bit more than what we believe to be fair market value for that business, here's probably the ceiling that I would go. And here's probably about as low as an offer I would make. From our standpoint, we don't have any skin in that game, regardless of whether we're on the sell side or the buy side. We just want to make sure that what we do is fair for both parties. Ultimately, though, on the buyer side, you want to walk away feeling pretty good about the transaction and getting a company for as less in terms of financial outlay as possible. Obviously, on the seller side, it's just the opposite. So it's really the two polar opposites that have to find something right in the middle.
Totally agree. But are there some assumptions that you might make? And I don't mean you, your firm, because you're not making some of these assumptions, but are there assumptions in the model that might change from a seller's lens to a buyer's lens? And one thing, for example, that I would point out is like the owner replacement salary. Are there some things that you would maybe look at a little bit differently if you're coming at it from the buyer's perspective? Or do you follow a benchmark and guidelines and you do that regardless of what side of the transaction you're doing the valuation from?
I would say that 90% of what we do is going to be pretty much a guideline to how we process and value a business and what we look at in terms of determining where that value is coming from. However, when working with a buyer, we do tend to look at the operation slightly different in terms of what they can do with it once they get it. So consider the fact that when you're valuing a business, the value of that business represents an as-is condition. So you are buying the business based on what the current owner has done with it up to that point, with everything that's in place at that time. A buyer, on the other hand, has the ability to go and look at that same operation and find some things that he or she may be able to improve. And there may be certain risk factors that they can improve as soon as they take ownership of the business. And those are the things that we can focus on to help them understand, hey, when you acquire this business for X, you could conceivably increase your return on investment within the first 2 or 3 months just by making a few small changes here or there.
Yeah, wow.
With your particular type of expertise or knowledge or background. So we do take a little bit of a turn there in assisting a buyer, but from a value standpoint, there isn't much outside of that we would look at.
Yeah, that's great. That's a great point. So Darren, we didn't really get into the weeds here today on the types of valuation. I mean, this is such a big topic, right? There's so much to cover, but we didn't talk about the different types of valuations, and there's so many other things we could go do. I want to wrap this up. one, I want to invite you back because I think we could get into those aspects and that could be very illuminating for the M&A Unplugged community. But are there some parting comments that you would like to leave to the audience? And keep in mind, we've got buyers and sellers and professionals and consultants that typically listen.
Yeah, I would say a couple of things as we leave here. One is that there is a different valuation for every single purpose. So consider the fact that whenever you do a valuation, that valuation has to identify a single purpose as part of its opening statement. So many people make the assumption that one valuation fits all purposes. It does not. So you may value your business, put it on the market for sale. That kind of valuation may not work for an SBA loan, and that kind of valuation may not work for an employee stock ownership plan. So there are different types of valuations for different purposes. And as a buyer or a seller, you have to be knowledgeable about what you're trying to accomplish because the appraiser will ask you those questions. Second of all, when it comes to selecting the appraiser, it's important to understand who you're working with. Not everybody is an appraiser, and there are lots of people out there that will claim that they will be. You're looking for somebody with the proper credentials. There are about 4 or 5 different designations in the field that you can feel good about when it comes to selecting an appraiser. And once you find somebody within that baseline of credentials, then you want to make sure that you find somebody that's got some experience, not necessarily in valuing your business, because appraisers are experts in valuing companies, period. Somebody who has experience in valuing businesses, whether they be on the private sector or for certain types of industries that they may have certain experience in. So always make sure that you're dealing with somebody who's got the proper qualifications, the proper experience, and then ultimately, in making that final selection, you want to make sure that you select somebody that has a similar characteristic and a similar type of personality that you do. Some people work well together, some people don't. You want to make sure that you're comfortable in talking about all these nuances about value and financial statements that you can get, and you want to make sure that you can do that with somebody that you relate to and that are on the same level with. So those are the 2 or 3 things I would leave anybody who's considering engaging an appraiser at any point. And ultimately, if they're looking to try to identify value of their business, they're going to end up running into some of those things along the way.
That's great. Great advice. Darren, such a pleasure to have you here. If the folks in the M&A Unplugged community wanted to reach you, how can they best get a hold of you?
The firm is GCF Valuation. We're based out of Tampa, Florida. Our website's gvalue.com, but if they want to contact me directly, happy to take questions. My email address is first initial, last name, dmize @gvalue.com. Direct line is area code 813-658-3502. And always willing to take questions from anybody. It's something that we do on a regular basis. And you want to talk valuation, I'm happy to take the call.
Darren, thanks so much. Really appreciate it.
Been my pleasure. I appreciate you having me on and look forward to another session.
Absolutely. So M&A Unplugged community, just to highlight a few things that Darren brought up. You're an owner of a business. You need to be thinking in terms of cash flow and risk. If you're marching down the path to maximize the value of your business with an ultimate exit in place, you want to maximize your cash flows, minimize the expenses that are going through the discretionary expenses, pump up your cash flow as much as possible, really show and depict the business in the best light. And then risk. We've talked about this on many other shows around the value drivers of a business, the key things that will increase or decrease value. One, the owner not being the business. Client concentrations. There's so many more, but you want to really be thinking about cash flow, risk, maximizing both of those so that you really can get the highest return. And if you're a buyer, I think Darren gave some outstanding advice. You want to make sure you don't get too emotionally involved in the transaction and so wrapped up in it that you lose sight of what the true value of the business is. And the reality is that values a range. There's a low to a high. I call it the reasonableness range. And as long as you're in the reasonableness range, even if you're on the high end of reasonableness, you're fine. But when things start to get unreasonable, then the odds that that business could fail or you could be in trouble will go way up. So I think that was awesome advice. And as Darren pointed out, you always want to be working with valuation companies that have the right certifications and the staff to deliver. Really appreciated him being here today. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember, that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.